Welcome to Dave and Dom Demystify, a FinTech Futures podcast, helping make sense of the world of FinTech and digital finance. Please sit back and listen as the two Ds take a subject and discuss it to make it clearer and easier to understand.
Demystify.
Welcome everybody to the Dave and Dom Demystify show, and this week we have a special guest who's going to help us to demystify a company in the US called Infinant. Has a fascinating background to it, but welcome Riaz Syed, founder and CEO of the company. Riaz, would you like to introduce yourself and give us a bit about your background, because I think that's totally relevant to today's conversation.
Thanks, Dave. Thanks, Durham. Thanks for the opportunity to be on this podcast. The three things I would like the viewers to know about from a personal perspective. I'm an immigrant to the United States. I came here to do my master's in computer science. So my background from an education perspective, my undergrad and grad school have been in computer science. So I started off as a software developer and then grew through the ranks and did software architecture job for a while. And that was one of my most favorite jobs, is to be able to design systems, and grew in the ranks to become a development manager. So that's how my career path progressed, being a software developer, software architect, and managing a software development group. From a domain perspective, my first job was a company in Charlotte, North Carolina, a company called Broadway and Seymour. Charlotte is a big banking town. So it so happened I started working for this company called Broadway and Seymour that was doing software and banking. Right? So that's how I got into financial services. That was 3 decades ago. This company was building software in the banking channel space. So my first project that I got involved with was building a teller system. So doing deposits, withdrawals, cashier's checks, everything that you could think of in a teller system, that's what I started first. And then in the United States, the software that is run by the folks in the bank for creating accounts and for maintaining accounts is called platform. So I started working on the platform system. So you can imagine all the stuff that you would have to do in a platform software to be able to originate accounts of different kinds and maintain accounts of different kinds. Then that moved into call center. As you can see, call center and branch software have about a huge overlap, 70-80%. You're still creating accounts and still maintaining accounts. And there is an aspect of CTI in the call center that doesn't exist in the branches, of course, but the functionality is still the same. Then online banking came in because of internet being prevalent, and then mobile banking. So this company that I worked for built channel software for all the different customer touch points. And the company didn't have any core banking system that they would put this software on top of. So when you sold it to the regionals and super regional banks, we had to go integrate with different core backend systems. That's how I learned a lot about APIs and integrate into different core banking systems, understand the intricacies, the differences of the core banking systems. Not all core banking systems are the same. And different ones using deposit systems, lending systems, commercial lending systems, mortgage systems. Imagine pulling up a customer profile in a call center. You want to pull up 80% of the customer information in the first screen. So we got to go integrate with all the systems to pull back. So my experience for the last 3 decades has been in the banking space, primarily in the space of channels, all channels in the bank, both self-service like online and mobile, and also assisted channels like banker and teller, and maybe semi-assisted like kiosks. So that's my domain experience, the technology background, domain experience. And my last job, this company got acquired by FIS, and I ended up in FIS. So that's how I got into one of the large behemoths in this fintech space. FIS ran a product development group there, left the company, and started a new company called Zenmonix. So the problem that we were solving was omni-channel solution. So omni-channel, as you know, is big buzzword a couple of years ago and still is, where the banks wanted to be able to originate an account in one channel, go pick it up in another channel. So they wanted to have contiguous customer engagement across multiple channels. So instead of building 5 different channel applications for 5 different customer touch points, we said we are going to build a single technology solution that has 200 banking components like account origination, funds transfer, account maintenance, all of those banking functions that you do on all these channels. Why build 5 different times? Why don't you build it once? And why don't you build an API layer to abstract away integration to core banking systems and third-party systems? So we built about 450 APIs that give us the flexibility to go run against any core banking system and also any third-party system for AML, KYC, any one of those things that are available in the market. And we did well. We sold the product to regional banks, super regional banks, community banks, and we got acquired by FIS in year 2020, right before COVID. And I stayed with the company for a year, and then I left and started this company called Infinant. So if you look at the background that I had, banking products were distributed via banking channels, and I worked in all banking channels, right? Sales and service, platform, teller, call center, online, mobile. The difference, the emerging markets, was now instead of just distributing your banking products through your banking channels, embedded finance, banking as a service, all of that was distributing banking products through a non-banking channel. Could be a brand, could be a fintech. So it was a very logical extension of using all the knowledge that I had to go build a new company. So Infinant builds banking technology platform called Interlace. And one of the use cases that we solve for is embedded finance and banking as a service. So that's my background, technology, domain experience, and have some experience building a company and successfully exiting.
I mean, Dave, before you jump in, I've got to say, doesn't his background sound very similar to what I've done at Lloyds Bank?
I was going to say, it's a part of the elite club of people.
Well, I am honored to know that it's your background as well. Your brothers from a different mother.
I was going to say, you're the better looking doppelganger for me.
I don't hear that quite often, Durham, so I take that with a lot of pride.
Well, I mean, it's an incredible kind of career, and I guess you've seen those changes that are kind of happening. One of the things I was keen to understand before we go too much into Infinite is what's going on in the US market at the moment, because there's been some sort of big changes from a kind of regulatory point of view, which I think have had, just in the last few weeks, have had a big impact on some of the BaaS players in the market. So yeah, I was keen to get your views on that and then come back to Infinite and how Infinite fits into the picture.
Perfect. I'll get into a little bit of history here just to set the stage, and then also talk a little bit about the challenges that the model is facing and where I think the industry is pivoting towards, or the players are pivoting towards. Traditionally, banks grew by mergers and acquisitions. Geographic footprint was the differentiator. Customers walked into branches to do banking. And then the digitalization happened, and the geographic footprint was no longer the key differentiator for these banks. These banks are now competing with the banks that are all over the country in the same weight class, the community banks, but they were also competing now, punching up their weight, is competing against the big boys, the big three, big four. So banks are looking to grow in alternate methods. So since your geographic footprint is no longer a differentiator, how do you grow? And I say necessity is the mother of innovation. So you look at various different ways you can grow in alternate methods. One of them is to expand your distribution channels. The banks owned all the distribution channels so far, right? Online banking, mobile banking, all the channels were owned by the banks. One way where the banks still control the last mile delivery, but bank expanded their channels, was they launched a new digital bank. Let's say it's a Bank A. Bank A launched a new digital brand called Bank A Direct. And they can push their existing products like high yield savings or high yield CDs, or they can create tailored products for an affinity group like doctors, nurses, immigrants, and hairstylists. So the two types of products that they're doing with this digital-only banks is push their normal products with higher basis points interest, or you can create a new product that is targeted to a particular affinity group. Still, the bank owned the last mile delivery. That's one way to expand your distribution channel. The other distribution channel where the bank does not own the last mile delivery is embedded finance. Large grocery store chains, pharmacy chains, or large retail giants are looking to embed banking products within their end user applications. These are nothing fancy. These are normal bank accounts for checking accounts, savings accounts, unsecured lending. These are regular banking products getting embedded into a brand's application. That's one way of expanding your last mile delivery. The other one was partner with fintechs. Expose your banking products as APIs. and work with these innovative fintechs that are creating new innovative financial products and use cases. One example would be to create those applications for gig economy workers. So you can get paid earned wages at the end of the day. So these are new products that are being created on top of the existing banking products. Again, work with brands, do just normal products distributed, work with fintechs who are creating new financial services products. So this is how you expand your delivery. And in the first scenario, in the digital brand, you still control the last mile delivery. In the second scenario, the bank doesn't control the last mile delivery. They're working with brands, they're working with fintechs and using their mechanism for distribution. So this was the need. The need was banks to grow in alternate channels, and the methods were using distribution channels to do it. Now, to do that, banks need technology. You have to have technology for supporting these alternate growth models. Banks were running traditionally, and they have traditional brick and mortar businesses, and they have core providers that they're getting technology from. But what if you're looking at these alternate growth models? Where do you get the technology from? The first place you would look at your core providers, because most of the community banks are getting the entire banking technology ecosystem from these core providers. So you look at core providers and you say, can you run a digital only brand? Can you provide me with APIs that I can go work with fintechs? Can you provide me with embedded finance capability that I can embed this product within a brand? Well, it doesn't look like core banking providers moved fast enough, created the solutions to satisfy the needs of these community banks.
Yeah, I just want to test that a little bit, because when I look at players, people like Temenos, they are doing it. They are launching them. But the problem is, like, then they're having to do a separate instance per player, right?
Very good point. Yeah, it's a very good point, because I've worked in large companies and they had a core banking solution that they use for brick and mortar. And they had a separate core banking solution that was for digital only brands, right? But still, if you look at the contract time duration, is multi-year contract. It's a multi-million-dollar contract. It's heavy for what the model needs to have. It's a lightweight ecosystem is what the model needs, not deploying another instance of the core. So if you look at the core banking providers, they have solutions, but the solutions were not custom fit for these new emerging models. What they were doing was taking the technology that they had and trying to put a square peg in a round hole and trying to figure out a way to make this thing work. So it's a very good point that you make, is there are solutions that the core banking providers are providing, but they're not exactly what the industry needs at this point in time. So they have work to do in that space.
True.
And then the other option is build it by yourself. So there's lots of fintechs that are doing some parts of the banking technology really well. There are companies that do AML, companies that do KYC, companies that do card, companies that do payments. I mean, you name it, right? They have done point solutions really well. There are certain banks in the United States, community banks, that have started up by innovative entrepreneurs. And they said, look, we're going to go build it by ourselves. So they build some of the components from ground up, like accounts and ledgers. They pulled in some card providers, or they did direct connection to Visa DPS. They pulled in some payment providers, or they built it by themselves. So a combination of building and buying and integrating and assembling some of these components together is what some of these banks did. So option one, go to your core providers and take what they have. Option two, which is expensive, slow, all of that stuff. Or option two is go build it by yourself. If you have the technology, IT staff to build it and the dollars to build it, go ahead and build it. So some banks did it. Option three was that created a window of opportunity for BaaS middleware providers to get into this space and say, look, not all banks can build the stuff by yourself. So the emergence of these BaaS middleware companies was to fill in that void. So they came in and they said, look, we will provide you with the technology for you guys to be able to embed within brands, being able to work with fintechs so you can create innovative products. So this is the emergence of BaaS middleware providers. Kudos to the BaaS middleware providers and the innovative bank CEOs, because they prove that there is an alternate way for banks to distribute their products through embedded finance and banking as a service. Now, that's the history. There's lots of challenges with this model, right? BaaS middleware providers were the intermediaries between the bank and the fintech. And in addition to providing the technology to the fintechs, some of these BaaS middleware providers also took on program management. which includes compliance monitoring. So I don't want to get into the details of all the issues that happened, but the net result of it is some violation of regulatory compliance issues and the issuance of consent orders by the regulators, right? That's the net result. So there were some challenges, and this was a net result. So in addition to getting the consent orders, what's really emerged in this space right now is the new model called direct BaaS model, or a model that was existing, but it's now become the de facto model that the regulators are pushing these banks towards, saying, look, a bank needs to be in full control and have a direct relationship with the fintech without having any intermediary like a BaaS middleware provider in the middle. That's my definition of direct BaaS model. That's what the regulators are pushing towards.
I guess, because some of our audience aren't US centric, but essentially the consent order was basically the regulator saying, just because somebody else is distributing your product doesn't mean that they're responsible for the customer owning that product. You as the manufacturer of the product, you, the bank, are responsible for all of the compliance around that product. And they basically said, you can't carry on unless you take responsibility for the products that you're now going to distribute through these third parties. That's the consent, right?
That's 100% correct. Right? Banks are the regulated entity. So when banks have used a middleware provider or an intermediary in the middle and use the technology from them and also use them for doing regulatory oversight, that's what has caused the problems. And the regulators are saying, banks, you are the regulated entity. The regulations and the responsibility for regulatory compliance starts and ends with you, regardless of using any third party.
So in those instances with the consent orders, these banks were suddenly finding themselves without knowledge of some of what their customers were up to. So they were basically flying blind around some of these aspects.
I think it's somewhat true, and in some instances, because the bank has used an intermediary in the middle. So there are 2 degrees of separation or 2 levels of separation away from the end customer. So it was harder for them to keep track of all the AML, KYC, and the fraud rules that they would like to look at. So the direct BaaS model is pushing the banks to have direct relationship with the fintechs, so they have a better control over AML, better control over KYC, better control over fraud rules and all the stuff that are important and essential for being regulatory compliant.
Yeah.
Well, I want us to see the positives as well. Having said all that, right, if you read past the headlines, the clickbait, it is still, the market for embedded finance is still large and expected to grow. So if you read Alex Johnson's newsletter from this past weekend, he said the fintech partnerships are one of the only viable non-M&A ways for community banks to grow. If I look at the statistics, as of January 2024, there are 13,000 fintechs in the United States, over 1,500 more from the same time last year. So fintechs are still growing. And if you look at Cornerstone Advisors, the percentage of mid-sized banks, even after all this noise, that are putting together a BaaS strategy is double the size of what it was last year. So last year it was 3.7%, 3.5%. Now it is 7%. So in spite of all of the noise, the banks are twice in number are looking at having a BaaS strategy for the future. So the market still exists and the market is still growing.
There's a fascinating stat. How is embedded finance growing in the US? I mean, we've got some examples here, but I'm literally talking about like a handful of examples. We've all heard about Uber offering finance to the drivers, right? And lots of other people thinking about it, but I run out of examples as such. Even when I look across Europe, I don't see too many just yet. I see a lot of interest in it though. And I just wonder, what stage is it in the US? Is there a lot of interest? Is there more than a handful of examples? Or how is embedded finance in the US?
I believe we talked to a lot of different banks that are in various different stages of embedded finance. There are some banks that we talk to that have about 150 to 200 programs that are running on top of it. There are some banks that we talk to that are looking, based on the current conditions with regulatory compliance, looking to create a direct BaaS model. And if you look at this shift in the model from a BaaS intermediary that was having a relationship with fintechs to now bank having direct relationship with the fintechs without an intermediary. The onus of going and finding the fintechs, the marketing, has to be done by the banks now. So banks traditionally are not great at selling it to fintechs. So one of the questions that we had for the banks that we talked to is, it's great that you want to get into the direct model. How are you going to go do marketing for these fintechs for you to go win this business? Are you not concerned because your cost of customer acquisition now shifted from the middleware providers going and getting the customers to now you getting it by yourself? And the answer that I get is they actually have more fintechs coming to them than what they want to onboard. And they have to be picky and choosy now to make sure that they do proper due diligence on them before they onboard on it. So they have to decline a lot more than the number of fintechs and the brands that are actually putting on their platform. So in the United States, the demand for those banking as a service and embedded finance is still very strong.
It's a very similar story across Europe that banks that are offering BaaS, and I'm thinking of players like Aon Bank in Belgium, NatWest Boxed in the UK, they're actually having to turn people away because of this regulatory oversight that says, look, you are ultimately responsible for their customers, right? From the banking product side of things, they're now having to really form partnerships. It's not them selling a service as such, but it's saying, well, look, let's really understand your business and help you to onboard the right kind of customers, et cetera, right? And let's just make sure that, we see that there's a growth story behind your business as well. So the last thing that you want is the first 20,000 customers come on and then 2 years later they run out of funding and they end up nowhere, right?
You're 100% right. There's lots of scrutiny going on from a due diligence perspective to look at the business case of the fintech, to look at the financials of the fintech, to make sure there's a long-term viability of the products and services that they want to offer before the bank is choosing them as one of the fintechs that they would onboard on a program. So clearly the scrutiny, the due diligence process has become much more robust based on everything that is happening in the industry right now.
So I guess against that sort of backdrop, I'm keen, because we've got time constraints as well, but I'm keen to explore a bit about Infinant and how you fit into that marketplace, because it sounds like, in many ways, rightly, the goalposts have moved in the industry. I'm keen to see how you fit into that now.
All right. I want to use a sports analogy. So since you're from the UK, I will use a soccer sports analogy, right? If it's US, I would have used the US football analogy. And
the real football is in the UK.
So I'm going to use the soccer analogy. Yeah. So there are rules for playing a game, and the rules have to be followed by the players, right? And when you're playing a game. So what I consider about in this space right now, the regulations and the regulators that have set these things are the rules of the game. The regulations are the rules of the game. If you violate the rules of the game, depending upon the violation that you have done, and your foul is called and you get a yellow card, and if the foul is fragrant, then you can get a red card, and then you have to go sit on the sideline for a game out or two, right? So that's what's happening in the industry right now, is the rules have been set by the regulators, and some of those rules have been violated, and the consent orders have been given, and everybody will fall in line, right? It's just a learning experience for them. But I believe once you get past the noise and once you get past these consent orders and the rules, what really makes a difference is technology. It's what I consider is just following the rules doesn't enable you to win the World Cup. You got to have a great team to win the sport, right? So in the analogy of sports, taking it to what we're doing in embedded finance, technology is your team. Technology is your enabler. So if you look around in technology right now, core banking technology, when we started building Infinant, we looked at all of these providers. Legacy core banking solutions from core providers had banks as the users. Their users were primarily banks. They've done a great job of making sure that their software is bank regulations compliant. Software is controlled by the bank. The bank had full visibility of customers, accounts, AML, KYC, and they were able to provide reports off of it. And they were able to create their process and procedures on top of that. That's what the core guys did good. BaaS middleware providers had fintechs as their users. So they focused on fintechs. So they created very good API portals, sample programs, sandboxes, documentation, and of course, the speed to onboard was much faster with those companies than what you would get with legacy providers. So when we built Interlace, we looked at the solution and said, our Interlace, our banking platform, we want to take the best of what the core banking providers did, what the middleware providers did, built an open system so we understand that a bank needs to have a choice to pick the components that either we bring to the table or they want to choose from their existing legacy providers or a fintech. So the system has to be open to give the bank a choice to use the technology components either from us or from the core provider or from a third-party fintech that has done a great job of doing it. And to be price competitive, you got to have a multi-tenant system, runs in the cloud in the SaaS model. And these are all the things that we looked at when we built Interlace. So Interlace is a banking platform. The key components of Interlace are accounts, ledgers, card, money movement. So these are the fundamental ingredients of the solution. And using our deep banking experience, we have built Interlace that powers multiple use cases for banks to grow through alternate channels. So I'll give you some examples. So using Interlace, the primary components being cards, accounts, ledgers, money movement, we are able to assist banks that are already doing embedded finance through banking as a service middleware providers. So they look at this regulatory environment right now and say, look, we would like to go into direct BaaS model. We would want technology so we can power technology that helps us become a direct BaaS provider and have direct relationship with fintech. So we're working with banks that are already doing BaaS for a long time and would like to shift into the model of direct BaaS model, and we are providing technology for it. So Interlace enables them, powers them to go do that. We are talking to a couple of banks that are new entrants into this space right now and looked at all the stuff that's going on and said, look, we would like to do direct BaaS model. We need technology for doing it. So we are powering them, giving them technology, enabling them to become a direct BaaS provider. Now, these are just distribution channels that the banks is using for doing embedded finance, banking as a service. But Dave and Durham, there's lots of other use cases that you can power if you do the technology right. The ingredients are the same, but the use cases are different. For example, one of the regional banks that we are working with is offering their bank's business customers using our virtual sub-account system, enhancing their liquidity management, and giving them advanced treasury management features. So all of that using our virtual account system that sits on top of the core and provides additional functionality to the business
Hold on
customers.
a sec. So what you're saying is that you can modernize somebody's existing core. They don't have to throw out their old core.
So the key point is exactly that.
Wow.
Exactly. So 3-4 different use cases. One, from a distribution perspective. So you're 100% right. So the use cases of going into new distribution channels like embedded finance, banking as a service. You want to launch a new digital brand for creating new products and services. You can do that. And the last one is what I just told you, is enhancing your existing core functionality by providing new features and functions like additional liquidity management, treasury management capabilities. The key point, you hit the nail on the head, Dharmesh, is banks don't want to change the technology that they have on their brick and mortar today. They're looking to either add new distribution channels or they want to add new features to their existing products that they have on their core banking system without disrupting it, adding new features and new capabilities that add value to their customer.
I wrote about this and I called it Eat As Much As You Like. So actually, you said you had 200 banking functions, but you only have to ship and provide what the customer needs to solve their problem. Is that what you're saying?
That's right.
Okay. Wow. And it's on a multi-tenant basis. I mean, this is fantastic. I mean, what I like about this is that actually, when in the tech world, we think being first to market is really important. Being the first captures the market share, etc. But actually having the benefit of hindsight, coming in a bit later and saying, well, actually, just moving to microservices isn't the main thing. Actually, it's microservices, the full Mac architecture, it's multi-tenant. We have to serve not only banks, but we have to serve the fintechs and allow the banks to do embedded finance. That's all hindsight of what's changed in the banking in literally less than 5 years, right?
Sometimes I feel like second mover advantage really helps you.
Yeah.
You can look at and learn from the mistakes of others. And you look at what the banks did, the core banking providers did great with the banking software they provide to the banks. They're multi-tenant on the bank side, and the BaaS providers were multi-tenant on the fintech side. So the solution that the industry needs is a multi-tenancy on both sides. You would be able to do multi-tenant on the bank, sponsor bank side, and a multi-tenant on the fintech side. So to your point, Dharmesh, sometimes it's great to be a second mover because you can look at the industry and find solutions from others' mistakes or other strengths, if you will.
Really interesting conversation because literally I've been writing about this for the last few months, and it's good to see a live example of it. Just going back to your analogy with the football pitch, I can see Dave is the referee holding up his watch and saying it's almost time. But Dave, now, have you got any last questions for Riaz?
I'm not a technology person, but I do absolutely get the point of protecting customers is completely vital in this. And I think that's sort of lesson learned. But I think having the ability to offer banks flexibility so that they can provide greater products and services which fit the way people are living their lives now, I think it is a tremendous thing. It's sort of, again, Dharmesh and I have talked about, this sort of feels like a new golden age, I think, in terms of banking and the opportunities in banking, because there is so much opportunity. And I think it's really exciting to kind of hear this, and excited to kind of hear the flexibility and agility that Interlace sort of offers its customers. So it's less of a question, more of an observation, to be honest with you. It's fascinating to hear how, there's a few kind of big things which are kind of happening at the moment, which seem to be converging at this moment in time.
I'm going to ask one final quick question, only because we have similar backgrounds and I got to a similar conclusion on BaaS as you did. Do you think we could have got to that conclusion, like a future of embedded finance and BaaS? Do you think we'd have got to that without the background that we had in, starting off with tellers and then going to the internet, etc.? Do you think without that, somebody would have come up with BaaS and embedded finance?
That's very important. The technology movement started off with core providers providing the whole ecosystem, right? And it was very essential for us to understand what the ecosystem is. So the core providers provide all the channels and all the technology solutions. And that taught you how to do banking products and ship it to the banking channels. Gave you a very good ground level understanding of it. You have to do that to come to this space. But a lot has changed since the time that we did it in a very bank legacy provider controlled environment. The fintechs have taken the UI, UX out, and there are fintechs that have taken card out, card as a service. Some has taken payments out, payments as a service. Some of them have taken AML out. So as you can see, the whole ecosystem that's provided by one legacy provider has slowly started being eroded, hollowed out. Dave Foss, the CEO of Jack Henry, used the term hollowing out of the core, or hollowing out of the banking ecosystem provided by core providers. The last thing that was on the core was accounts. And the BaaS middleware providers actually took the accounts out using virtual account system and an FBO mechanism to the host. Even that is out. So there's lots changing in the ecosystem of banking technology that gives a lot of opportunity to providers like us who have understanding of how this ecosystem was built in the first place. So if you disassemble a car, you got to know how to build a car first to go put it back together, right? So to your point, having a good understanding of how the original ecosystem was built is very essential for us to disassemble the ecosystem and build a completely new paradigm in banking technology.
You're very humble. But I really appreciate, you sharing all your insights and fascinating background. I'm looking forward to see how the company progresses. Thank you.
Thank you, Dharm. Thank you, Dave. Appreciate it.
Thank you so much. Brilliant.
Thank you for tuning in to Dave and Dharm DeMystify. We hope you enjoyed the show. Don't forget to like and subscribe, and tune in next time as we take another topic and demystify it.